India's fixed income market is navigating a dynamic environment with RBI rate cuts, global monetary shifts, and evolving credit demands. To help us decode what lies ahead for debt investors, we are joined by Mr. Abhishek Bisen. Thank you for joining us, Mr. Abhishek.
Thank you.
So, first of all, Mr. Abhishek, please tell us, how do you interpret RBI's recent rate cut and its potential impact?
This is one of the boldest monetary policy announced in the recent time. RBI has cut rate by 50 basis point and also announced a 1% CRR reduction, which will release almost 2.5 lakh crore worth of liquidity going forward. This has a positive impact on the interest rate cycle, and we are still in an easy interest rate policy. However, since the RBI changed the stance from accommodative to neutral, market got slightly concerned, and there was a profit booking across the yield curve, which took the yield curve up by almost up to 30 basis point across the curve, which is what probably is concerning to the investors and market participant. However, we believe that this is an opportunity rather than a threat, and investor must take it as an opportunity because we are in an easy cycle, and RBI is unlikely to change the monetary policy cycle going forward in the near term.
So, as you said, the market has become a little concerned. How do you think the investors are going to react on this?
That's what I said, because investors have panicked, and some of the investors and some of the market participants have started booking profits, taking it as a end of the monetary policy easing, and reversal is anytime soon. However, if you look at the data points, particularly inflation, we don't think so reversal is anytime soon, at least in next 12 to 18 months. And there is further scope of easing if the data supports. If you look at the monsoon or the crude oil prices in general, both the data points are supporting towards further easing. However, only we have to wait for the next policy to see, or next to next policy to see the same.
So, how do you read out VRRR announcement by RBI?
So this is again a slight shocker to the market in terms of VRRR. VRRR is generally perceived as withdrawal of liquidity. On one hand, while the RBI was aggressively adding liquidity, but this time around they have announced a VRRR auction of 1 lakh crore, which will withdraw the liquidity from the system. But please note that this is just fine-tuning operation and not withdrawal or tightening operation. With month-end spending and other activities in the system, overall liquidity would have been in a significant surplus mode, which probably would have taken the call and the overnight rates closer to 5%, which is probably not in line with the monetary policy objective, and which is why RBI has announced 1 lakh crore worth of VRRR. And it's a very short-term auction. It is a 7-day auction, and once the liquidity normalizes, probably this may not be a regular phenomena, but they will keep on fine-tuning the liquidity so that the overnight rates keep hovering in the band of 5/4 to 5/2.
Let's also talk about geopolitical tensions. For example, Israel-Iran war or the prolonged Russia-Ukraine war. In times like these, how should debt investors navigate through global uncertainties, especially in terms of low inflation risk, oil prices, or safe haven demand?
Yeah. So again, this has been a Six Sigma kind of an event where it was perceived to be a very short-term lived when the Ukraine and Russia started. So it's been almost 3 years now, and we have seen Israel-Gaza or Israel-Iran conflict emerging, and effectively some between India and Pakistan as well. However, that has not disturbed the overall macro landscape. This definitely adds towards anxiety to the market. But if you look at the crude oil prices, had you would have been betting on that, probably everybody would have said the crude oil prices would have go to 100. Despite all possible kind of tensions erupting, war erupting, theory becoming practical in terms of expectation becoming a reality that the war is going to happen, and eventually it happened, the oil didn't go beyond 80 in a significant way. And as we speak, it is trading at around $68 mark. So we don't see that eventually impacting the oil prices in a negative way, and therefore it is likely to remain in the comfortable zone. Yes, these kind of events definitely have a negative impact on the growth, and which is why the central banks are likely to remain slightly easier than tighter in the monetary policy.
Okay. So, what's your advice for the debt investors looking to invest in this space?
See, what we would like to tell them, we've been telling that one should look at match the duration of the investment with the duration of the underlying fund. The yield curve is steeper, and if you look for stability, you have to stick to the shorter end. However, if you are looking for some kind of returns, you have to go to the longer end as well. While the longer end is volatile, but offers decent risk reward going forward. Therefore, one has to decide the objective and look for investment.
Thank you so much for joining us and sharing these valuable insights.
Thank you.
I'm sure this conversation will definitely help the debt investors to navigate their way in the debt market landscape. Thank you all for watching and stay tuned to Kotak Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.